This video covers example 1 in the chapter 6 notes. I am on the second tab in the notes, and the instructions say put the account balances in the T accounts, and then number 2, prepare closing journal entries, which I have a template for those on the second page or next page. So over here at the top, notice that it says assume the following normal account balances on December 31st prior to the closing of the temporary accounts. Just a reminder, normal balances are always on the side where we record increases. So step 1 is just to simply put the account balances in the T accounts. So for cash, that is an asset. It would go on the debit side. Accounts payable is a liability. That balance would go on the credit side. And just remember that we've talked about how the rules of debits and credits are just a pattern. They're just a set of rules. Don't overthink it. Don't overanalyze it. Don't look for some deep meaning. It's just simply our rule is assets are increased with debits, and therefore we always expect to have a debit balance, a positive balance. We don't really have negative assets. If we had negative cash, in other words, a credit balance and cash, we would really say that's a positive account payable. It's not a negative asset, it's a positive liability. So in summary, we always expect account balances to be on the increased side, the positive side. So we have cash, we have accounts payable. Owner's capital has a beginning balance of $2,000. Delivery fees, that is their name for the revenue account. That has a $2,500 balance. We have wages expense of $1,000. That would be a debit. We have rent of $500 and supplies of $250. And then drawings, $150. So that is it for step 1. We have put the account balances into the T accounts. And then step 2 says prepare closing journal entries. And we're actually doing the journal entries on the following page, but we will jump or flip back and forth between this page and the next page. So when we do the closing entries, number 1 says to close the revenue to income summary. The income summary account is just an account that is only used in the closing process. We have permanent accounts and we have temporary accounts. You can think of the income summary as a super temporary account. It is only used in the closing process. Closing entries are commonly missed on exams. There's really not much to it, but I do think there's something about the concept that's confusing. But all we are trying to do is simply to take these account balances right here. These are temporary accounts, revenues, expenses, and drawings. We are simply taking these account balances. We want to zero out these account balances and transfer them to owner's capital. For revenues and expenses, what's going to happen is we're going to take these accounts, we're going to close them to income summary, and then we will close income summary to owner's capital. So simply, we're going to take revenues and expenses, they're going to flow through this account, and then they're going to go into owner's capital. So number 1, close revenue to income summary. I can see that revenue has a balance, a credit balance of $2,500. If I want this account to equal 0, I will have to debit revenue. That's half of my journal entry. On the next page, here's my template for closing revenue. So we're going to debit the revenue account for $2,500, and then we will credit income summary. For $2,500. So back to the T accounts, I've already put the debit and revenue. That balance is now 0. And then the other part of my entry, I had a credit to income summary. And so I've simply taken revenue, zeroed it out, put it into the income summary account. That's step 1. Step 2 says to close expenses to income summary. So when I look at my expenses, they all three have debit balances. That account needs a credit to be 0. That account needs a credit to be 0. And that account needs a credit to be 0. So I credit wages expense 1,000, rent expense 500, and supplies expense 250. So in my journal entry, and I know we write the debits first, but I'm going to put the credits down and then come back and do the debit. So we credit wages expense, rent expense, supplies expense. So we need to credit all three of those accounts to close them. And then we'll add all three of those up. That totals $1,750. And we will debit income summary for the total of those expenses for $1,750. So again, I simply just said these accounts have debit balances. Therefore, I would need to credit those accounts to make those balances 0. And I'll put that debit into income summary. And now at this point, income summary has a balance of $750. And this is just a subtotal right here, and then the overall balance down here. Now, income summary, don't overthink it. Income summary, it's a summary of income. And I know I've said in previous videos, the account titles are not meant to be creative or tricky. Income summary is nothing more than a summary of income. Well, what goes on the income statement? Revenues and expenses. Never dividends. So we do not put dividends in the income summary account. So do not put dividends in the income summary account. In fact, that's worth writing down here. Do not put dividends, or drawings, I should say. Do not put drawings in the income summary account. Drawings are called dividends if the business is a corporation. So sometimes I might accidentally say the word dividends, but we do not put drawings in the income summary account. Now we are at step 3, close income summary to owner's capital. So I can look at income summary. It has a balance of $750. If I want that account to be 0, I need to take that credit balance and offset it with a debit. So if I debit income summary $750, that account balance will now go down to 0. So in my journal entries, debit income summary $750 and credit owner's capital $750. I've already posted the owner's capital transaction, and then income summary, putting income summary into owner's capital, I will credit that account. And I'm going to go ahead and label this. So we had beginning, and then by closing income summary to owner's capital, we just put net income into owner's capital. So owner's capital has the beginning of 2,000 plus net income. And now we are at step 4, close drawing or drawings. That should really say drawings. Close drawings to owner's capital. So I can look at this account. It has a debit balance. It needs a credit to make that account equal 0. So when we do our journal entry, we need to credit drawings, and the debit side of the entry is to owner's capital. Now I'm still putting debits on top and to the left, credits on bottom and to the right. but I just wrote that credit down first and then kind of worked backwards to say, okay, if I'm crediting drawings to close it, I know the other side of the entry, the other half of the entry, has to be a debit. So we post that debit to owner's capital, 150. Put a little note next to it. And now we have ending owner's capital of $2,600. That will go on the balance sheet. These accounts, income summary, revenues, expenses, and drawings, now have a zero balance. Now our income statement, again, that will only include revenues and expenses, not drawings.